Forex market, some people call it FX. Basically, it's currency trading, decentralized global market where all the world's currencies trade. Traders consist of banks, businesses, governments, investors, and retail traders like me who speculate on currencies. And so the trading hours, this is something that's very important. Like, when are the trading hours? Well, this is showing us, trading is 24 hours on the Forex market. Let's just make sure that everybody understands that. It doesn't ever shut down. It's even on the weekends you could trade, doesn't matter. It does kind of go through a little weird part from Friday, 5 p.m. East Coast time to Sunday, 5 p.m. East Coast time. It kind of shuts down, but you can still trade. But, it kind of shuts down. It's the weekend session, and it's kind of weird. There's no strategy that's ever is just a straight winner on the weekend. So that's why people don't trade on the weekends, else they would, right? 5 days a week with the most important world trading centers being located in London, New York, Tokyo, Zurich, Frankfurt, Hong Kong, Singapore, Paris, and Sydney. A lot of people love to trade this London session. The London session starts around 11 p.m. Pacific Standard Time, or like, what time is that? 1 or 2 around the East Coast time. And then you got the New York time that's going to bust early in the morning, 9 a.m. East Coast time, or 6 a.m. Pacific Standard Time. So these are the 2 sessions that are the most traded sessions. And you'll notice if you're just trading in between the New York to the London, you'll notice like as soon as London hits, the market will start like reacting and start moving and grooving again. But there's a little time between New York and London that, it's kind of easier to trade for the average person. And so right now we're in that time where a beginner can trade pretty good right now because the market's not going to be moving too erratically. Okay. It's the most liquid market with an average of $5 trillion a day. And I like this little graph because New York Stock Exchange, $22 billion a day. Tokyo Stock Exchange, $18 billion a day. London Stock Exchange, $7 billion a day. But then you're talking about trillions of dollars. And that's really what it looks like. Like, this is like on the ground, not even a bump on the road to $5 trillion, right? And we know now, this is a little older presentation. We know now it's like $6 to $7 trillion a day. So it's even way, way more bigger. And these other ones aren't moving that, even in comparison to that. They're probably still at their same levels. There is no central marketplace. There's no like, you got to go through here to trade it. Like, there's all kind of different brokers, all different kind of stuff. Trading is conducted over the counter. It's not like stocks where there is a central marketplace where all orders are processed like the NASDAQ or New York Stock Exchange, right? Forex is a product quoted by all the major banks, and not all banks will have the exact same price. So, we go through a bank and our broker is called 8cap, most of us, right? Well, if you have another bank or another broker, you'll notice the prices are slightly a little bit different. They're not going to be like $10 off or anything, but they're like a little bit different. You'll notice that. So there's not like one person that gives all the truest quotes. All right. Forex trading is a speculation on the price of one currency against another. So if you go down to Mexico, or if you have ever been out of the country, in Mexico, they got something called a peso. I think the peso is like 19 pesos for $1 right now. And so you could buy 19 pesos for $1, but if you sell the 19 pesos back, you're going to get less than $1. You'll get like 98 cents or something more. So there's always this fluctuation in price to where the government or who's ever selling the money is going to make a little bit of percentage. And that's what happens when you get into a trade. The government or the broker is going to make a little bit of percentage on you buying or selling. So they get their profit, and then you make a profit if it goes the right way for you. Imagine exchanging $100 USD into pesos, then the peso value increases. Some people do that. Sometimes they'll go down to Mexico, they'll buy all kind of money in pesos, sit it under the couch, and if it goes up, it goes up. They're doing really good, right? Some people, they do it the other thing. They come to America, they buy the dollar, and they see that the dollar always increases. So when the dollar increases, and they go and they get pesos for it, and then they made money off of that. That's the old way to Forex trade, is to go to a different country, buy the currency in the other one, and then wait for it to go up or down, and then trade it back in and make money. Now we just do it online and we make money immediately. We don't have to go to the exchange on the corners of different countries. The value of one currency expressed in terms of another. For example, EuroUsd during this presentation, Euro was 132. Basically, the USD was 132 to 1 euro. So for every one, let's say, dollar in the euro, it would be $1.32 for us that we'd have to pay for 1 euro. Now, the US has gotten so strong that now it's dead heat. It's like $1 each. So think about it. It went down almost 32% to now be equal. Euro and the USD is like almost equal right now. Okay, so the smallest increment of price movement a currency can make, also called a point or points, for example, 1 pip for the Euro USD, you'll have to go 3 after the penny. So the penny is right here. This is the penny, and you're talking about 1, 2, 3. This is 4. So 4 away from the penny equals 1 pip. So all you needed, you don't need it to move a penny. You don't need it to move a tenth of a penny, a hundredth of a penny, a thousandth of a penny. All it needs to move is 10,000ths of a penny for you to make money, which is beautiful because that's always going to happen. It's always going to go up and down that number because it's so far away from the penny, right? A lot of you guys don't know about leverage, but leverage can really help you, and it can really hurt you if you don't do it right. So leverage is the ability to gear your account into a position greater than your total account margin. For instance, if a trader has $1,000 of margin in his account and he opens up $100,000 position, he's leveraging what? 100 to 1. So he only has $1,000, but he's trading for $100,000. So if it goes up, you can make tens of thousands of dollars really quick, or if it goes down just a little bit, you get wiped out in your account. That's why we don't trade like that. What we do is we trade, we basically partnered up with the bank, and then we pay them a small portion. Like for $700, we can get $100,000 position in a bank. Now, if we take one bad trade, we don't lose everything. Now it's like you really actually are trading $100,000. So you can take your time and really win. People that leverage too high get wiped out. In America, I believe the highest leverage is 100. It used to be 1,000 or 500, but then everybody was losing, complaining. So in other countries, the leverage could be 500. The leverage could be 1,000. So you can imagine having $1,000, leveraging 1,000 of that, and that turns into what? $1 million. So you could be trading $1 million account. If it goes south $1,000, you lose the whole 1,000. But if it goes up $100,000, you win $100,000 just off of $1,000. But what's the odds of it not going at all down before it goes all the way up like that? Think about that. So a lot of people were losing. If you open a $200,000 position with $1,000, that means it's 200 to 1. So you guys can do the math on that. Increasing your leverage magnifies both gains and losses. And what we don't want to do is magnify losses. So let's not even worry about the leverage. We got the good funding program that helps us out with that. Currency pairs. So there's the base currency is always on the left. The quoted currency is always on the right. So what this is saying is that 1 euro equals $1.32, 105. Okay. The reason for this is because in any foreign exchange transactions, you are simultaneously buying one currency and selling another. So any transaction that happens, somebody's buying one side, the other person is selling the other side. Okay. If you were to buy the Euro USD and the Euro strengthened against the dollar, you would then be in profitable trade. So let's go over the bid price. The bid price is a price at which the market or your broker will buy a specific currency pair from you. Thus, at the bid price, a trader can sell the base currency to their broker. So this is, what you're buying and what you're selling. And you see there's a little different number. There's like the 7, this is an 8, and then it shows you right here how the spread is 0.0021. So you're going to get in the trade and you're going to be down 2 pips if you buy it or if you sell it. Okay. The asking price. The ask price is a price at which the market or your broker will sell a specific currency pair to you. Thus, at the ask price, you can buy the base currency from your broker. All right. 2 types of trades. You can either buy or sell. Most people are hot right now. I was talking to this pastor that does the feeding program for the homeless with me on the weekend, and he said that God was providing for him because he bought Bitcoin and it went up. And he said in one day he lost $40,000 in Bitcoin. And I said, well, did you take out the Bitcoin and turn it into cash? And he said, no, but I lost 40,000. I said, no, you didn't lose 40,000 yet, because it can still go back up. I said, when you take out your money, and then that's when you lost your 40,000. You can get back in at that same price. You really didn't lose anything, because, Bitcoin is just a different currency than the dollar. All right, long. You guys will hear words from me called bull and bearish, bullish, bearish. So buying, long. When we go long, it means we are buying the market, and so we want the market to rise so that we can then sell back our position at a higher price than we bought for it. This means we are buying the first currency in the pair and selling the second. So when you're going long, if anybody says, hey, I'm going long, that means you're buying, okay? You're buying. And then when you sell your position, you want to sell it when you're winning, when you're profiting. Then you close out the position. It's like you sold it at that price, but you bought it for the other price, so you made money. So if we buy the EuroUsd and the euro strengthens relative to the US dollar, we will make money. The opposite of that is called bearish or short. This is called selling, short. Remember, long going up, short going down. When we go short, it means we are selling the market, and so we want the market to fall so that we can then buy back our position at a lower price than we sold it for. This means we're selling the first currency in the pair and buying the second. So what does that mean? We're selling the currency, it goes down to a certain point, and then we close out the position. That means that we basically bought it in other terms, but when you close out the position, that means you get that profit because you sold the position and then you closed it out, meaning that you came in and went up profit for you or went down some more, so you're doing better, you're profitable at that, okay? So if we sell the GBP USD and the British pound weakens relative to the US dollar, we'll be in profit. Okay, there's always a fight, and the fight is the Forex fight is called bulls versus bears. The bulls are the ones that are buying, for it to go up. The bears are the ones that are selling for it to go down, and there's a constant struggle. It's always like that. Even if it goes up really fast and the bulls start, beating the bear, then the bear usually is hibernating, and then it comes back and it starts drilling them back, right? And then the other way, the bear come in, man, they start attacking, boom, boom, boom. The bull takes a beating, and all of a sudden the bull a couple of days later, a week later, or whatever, a minute later comes back and it starts saying, I'm not taking this crap forever. It's like humans or like a cat. You put him in against the wall, he might be little or he might be getting beat up on, and then all of a sudden they got this little burst of strength to where they attack back, and it like scares the other person, and then the other person backs away, and then now the littler one is starting to gain on it and becomes a bigger one. So this is always a constant fight that we have. And this is mostly in like the scalping that the doc does really quick. Like, we call it breathing. One's going to be going, like if it's in an uptrend, the bulls are just beating the crap out of the bear. And then all of a sudden the bear will get a little bit of energy because the bull needs to slow down and stop attacking. And so it'll go the other way for a second. And then we get it at a good price and it bounces back up, and then we get it and we win. And this is what it looks like right here. The red are basically the bears, and the green is basically the bulls. And this is in a bull movement right here because it's just going up, up, up and away, right? How can we tell? Because right here, it starts right here, it goes up, goes back down, right? But then it goes way higher. So this is a bull market, we would call it. This is a bear market. It starts up here, and it goes down. Yes, it breathes, like we said. Then it goes down again, and it breathes a little bit right here. It goes back down again and starts breathing, and it goes back down, right? So technical analysts, the things that really will help you guys is to learn about the RSI, the MACD, the Satochic, volume, moving averages, Bollinger Bands, multiple time frame analysis. I look at the 1, the 5, the 30, the hour time frames. I look at 4 different time frames in my strategy. Then price action. We're always looking at price action, like what is the trade actually doing? Price action is, we see right here is going up, right? It's outside the Bollinger Band. Without looking at anything but these candles in this Bollinger Band area, we could tell it's going to come back down pretty soon, right? And then divergence. We always look at divergence. Divergence means that you know, even though, let me show you one right here. This is high. This is almost the highest, same thing. Actually, let me see a divergent if I could spot one for you. All right, this is a divergent right here. If you look at this area right here, this is a divergent. It's flat. Okay, so it looks like the trade should be going left to right. But if you look up here, the trade's actually going down. So this area right here, it comes from right here. If you look and you just go up here, it's just going left to right, right? But what we see is that it's going down even further. Look how further it went down right here, and it's still acting like it's just going left to right. So that's a divergent right there. Usually a divergent is way for you to realize that the market is going to shift the other direction. So that's about it. Those are the PowerPoints I want to show you guys. And let me go ahead and stop that recording. You guys will have